Hi guys, welcome to my YouTube channel. Hopefully you're doing great. Today we will be talking about the mutual funds. As the word suggests, mutual fund is a fund mutually collected through public investors who invest in a fund created, which then been invested in a collection of stocks, bonds, money market instruments. For instance, you've been collected $100,000, which you then been invested in combination of stocks, bonds, money market instruments. For instance, $30,000 you invested in stocks, $40,000 you invested in bonds, and the remaining 30,000 you have invested in other assets. So this is how you have invested, and grouped together they were called as one single investment instrument, which is called as a mutual fund, which means it is mutually funded by the public investors whose money then being utilized to buy all those securities. Now, who actually created this mutual fund is the asset management company, who has the fund managers who manages the fund. Whatever the investment received, they would create a portfolio which diversify the risk in different securities so as to increase returns while reducing the risk levels. Thereby, fund managers were very important because they were managing the fund in order to produce capital gains or other incomes for the investors. Then we have mutual funds, which actually providing investors, which are small investors, individuals who do not have the access to make larger investments like into the stocks or in real estate, but smaller pools being invested, and it make a greater pool which then being invested in such larger investments. So this is for the benefit provided to the small investors in mutual funds, and each shareholder therefore participates proportionately in the gains and losses. Now let's just understand it with an example. Mr. A invests $10,000 in a fund while Mr. B invests $50,000. So total we have a $60,000 investment which then be received in mutual fund. Fund then earn 5% in a particular month. So whatever the investment being received, which then being utilized by the fund manager to invest in different securities. So the securities investments provide monthly return of 5%. This return was then proportionately divided between the investors as per their investments. So therefore Mr. A will get $1,000 multiplied by 5%, which is $500, while Mr. B will get $2,500 because their investment is $50,000. Thereby he will get 5% on 50,000, which is 2,500. So thereby proportionately gains being distributed according to their investments. Then there comes the question, how is the performance of a one single mutual instrument being recognized, whether this mutual fund is performing well or not? How can a new investor know should I invest in a mutual fund or not? So thereby the concept is of market capitalization. Each and every day the market capitalization changes. So whatever the change, whether it is a positive or is a negative, it impacts the entry of new investors or exit of existing investors. Because if there is a negative change, then existing investors will go out, while in case of positive market cap, the new investors will invest in this mutual fund because it is performing well. Now, what is the concept of market cap? Market cap is basically the market price of those underlying securities. It can be either stocks, it can be either bonds or other assets. So whatever the market value of those stocks is, it has been taken into account in the market capitalization. Now, what ways a typical investor earn through mutual funds? There are two ways. The very first way is earn from dividends on stocks and interest on bonds. We all know stocks provide periodic dividends and bonds provide periodic interest rates. Now, dividends do vary. It's not being given by companies on fixed periods. It can be announced yearly basis. It can be announced 2 to 3 times in a year. So it is one type of income which is being earned by investors on stocks. Then comes the interest rate, which is a periodic payments on the bonds, which were called as coupon payments, which is being then given to the investors in the form of interest payments or coupon payments on their investments on bonds. Then comes the second type of returns which they would earn by invested in the mutual funds is by selling the securities. By selling the securities, which could be stocks or bonds, you will earn capital gain. Capital gain is simply the change in the price you buy and the price at which you sell. So if the selling price is higher than at what price you buy, you would have a gain on either the security, which could be a stock or bond. Therefore, you see that this way we also earn incomes or returns on mutual funds. Of course, mutual funds have those underlying assets which could be in the form of bonds or stocks, which then earn this returns in the form of dividends or capital gains or interest payments. Now comes the net asset value. It is the price of the mutual fund. We have talked about mutual fund has a value to it through its underlying securities. So whatever the value of those securities, which we have talked about in the market cap, which is the market value of those securities, that could be the market value of those assets. But then net asset value is a net value of an asset. So we have to deduct something out of those asset value of those underlying securities. So we have to deduct some expenses, for instance, the expenses to administer the mutual funds. We also have to deduct the liabilities which has been incurred by the mutual fund. Therefore, we will come to the net asset value. But it is the total value of the mutual fund. We need to know the value per unit of mutual fund. Thereby, we have to divide it by the outstanding number of units. Now, of course, the whole value of the mutual fund is very, very, very large. You can't expect one investor to hold whole mutual fund. So you have to divide the value of total mutual funds into number of units, so that according to the investment of investors, they would have units accordingly or proportionately to their investment. Thereby, we need to express the net asset value according to per unit or share of a mutual fund. So this is how you calculate the value of net asset value, which is actually the price of a security. Now, one thing which is very important is that this price is settled on each day at the end of the trading period. Unlike the stock exchange where prices being fluctuated continuously, in net asset value or the mutual fund value, it is being set up at the end of the trading time, which could be only one fixed price for a day, which is being calculated at the end of the trading day time. Also, mutual funds can typically be purchased or redeemed. As I have told you, it's very open-ended fund. You can come and go out anytime. So you want to come, you have to pay this price, which is being set up in the form of net asset value, or you want to redeem. So if you want to go out of this mutual fund, you should take your investment back and sell it at that price. You will take that money per unit of the share you are held for a mutual fund, and then you go out from this mutual fund investments. So both options were available, and this option is available at this net asset value price. Then comes the very, very, very important question: why to invest in mutual funds? The very reason is it provides public or individual investor and access to professional expertise service. Mutual funds being managed by fund manager who is expert of investments. He knows the return and the risks the markets faced. So accordingly, you would create a portfolio. Thereby, you would have this advantage that your investments being managed by a professional manager. Secondly, the risk diversify, because as a investor, no matter whether you have a small amount or a larger amount, you being invested in one or two stocks. If those stocks performance went down, you don't have other option, you lose all the money you would have. But in mutual funds, the investment is not invested in one area or two area, it is being invested in different stocks, in combination of stocks and bonds, in different securities with different risk levels, so that your risk is diversified. If one goes well, the other might go not well, so thereby you still have some returns available, unlike in a very first case where you lose all. So your risk is diversified. Also, it provides you the liquidity. As I have told you, it also provides you the flexibility. You can come in and out anytime. If you want to invest, you have the net asset value available at which you have to buy the share. Then you also have the redemption option available, whereby you want to sell your investment or unit at a net asset value price settled by the end of the day. So this provides also you the flexibility, also the liquidity, because at times you need a liquidity, or for any other reason. For instance, you might face an emergency, so you need a liquidity. Thereby you have option to redeem your investment and get your money back. So it gives you all this very important benefits: diversification of risk, professional management, liquidity, and flexibility. And there comes our example as well, which we have already discussed about the diversification of risk. Then comes the categories of mutual funds. Now, mutual funds being categorized in different ways. The very first category is of equity funds. Now, as the word suggests, hereby all the investments which is being pooled up, being invested in different stocks, different companies with the very good returns, with very low or minimal risk. You've been choosing those companies, stocks, and then invested your funds in those equity markets. Of course, this market is very volatile. They carry a larger risk, so you will be also getting a larger returns as well. Then we have the income funds. Now, in this mutual fund, your investments being invested on those securities which provide you regular incomes, like in bonds. You will knowing that you will get the coupon payments periodically. So this type of fund is invested in such securities which provide you a regular incomes. Then we have money market funds. Of course, money market funds being utilized by those investors who have excess cash, so they want to earn some returns out of it. So thereby they would invest it in this money market fund, whose funds then being invested in those securities who have a maturity of less than a year, like treasury bonds, yours, certificates of deposits, bankers acceptances, negotiations of deposits, certificates of deposits. So all these funds or money market funds, and it just gives short-term investor an advantage to come in, invest in those funds and get periodic income levels. Then comes the balance fund. Now, balance fund, as the word suggests, here the fund is being invested in either stocks or in securities like bonds. So here the combination of debt and equity is maintained. Thereby it's called a balance fund, whereby you also earn capital gains over stock levels, and you can have a regular incomes on the bonds. So it just gives you a balance. Then comes the Islamic funds, which were invested into the Sharia compliance securities like sukuk bonds. So hopefully you have learned about the mutual funds. We will be bringing a new video where I would be telling you what factors you have to see when you are going to invest as an investor into a mutual fund. Then I will be showing you the real example of some practical mutual funds of some other bank, so that you should know how you have to analyze a mutual fund and make your decision which mutual fund you have to choose, and what factors actually you have to consider for return and risk profile. So if you want to see all those videos, do subscribe my channel, like and share this video. Till then, thank you for listening me. We will be meeting sooner. Bye bye.